Hey guys, what's up? This is video number 4. We're going to be talking today. Well, actually, this is Nate, and then this is John. Yeah, say hi. And we're kind of going to be asking questions from the position of a beginner standpoint on like options in general, and it could also be applied to stock trading as well. So, yeah.
Right.
Do you want to go ahead and ask the first one?
Yeah, I guess the first question is like, what is RSI and what does it mean for stock price, option price, stuff like that?
So if you kind of watch the other video, I kind of talk about RSI, but basically RSI stands for Relative Strength Index. It's a study. So as you can see here on the screen, if we go up here to studies and go to edit studies, go to the search bar and type in RSI, you'll see it, and then you can click add selected. I already have it, so it doesn't really matter, and then you click apply. When you click apply, this bar right here will show up, and from your like beginning to use RSI, can you explain as a beginner like how you've like learned to use it, or like kind of, because I'm gonna give a technical answer and you're gonna give a beginner answer. So like, what is your beginner answer to what RSI is?
I have no clue what it is, I'm gonna be honest.
So basically it just shows the strength of how it's trading in the market. So there's overbought and there's oversold. There's a range of 30 to 70. You know how you rank stuff from like 1 to 10. So basically when it's under 30, it's way oversold. So like no one's buying it, everyone's selling it, and it's just, the volume's terrible and it's just oversold. When it's above 70, that means it's overbought. And you'd be like, well, what difference does it make whether it's overbought or oversold? Well, whether it's overbought or oversold is a strong indicator on whether or not that it's going to pull back or whether or not it's going to grow. So for options, that's extremely important, because if it's going to pull back, then you can buy puts, and if it's going to grow, then you can buy calls.
So if it's oversold, it'll go down. If it's overbought, it'll go up.
If it's so indicator, technical analysis is just a factor in determining stock price movement. It's not like it's set in stone that it's going to happen, that it's, you know, it doesn't say when exactly it's going to happen. That's why it's called an indicator. So it's just an indicator that it might happen, which is important to know, because, you know, it may not and it may. So you can't invest all your money in something just because one indicator says that it is. So if you look at the screen, you can see that as soon as it enters this red region, which would be overbought, you can see that on the stock price chart it begins to descend or fall or tank. I know that right there is the beginning of the major tank that we saw this past month. And on this one too, it's just beginning to be overextended as well. So it could potentially get ready to pull back as well. So that, and if you watched yesterday's video or 2 days ago's video, I talked about how I was going to keep a watchful eye on Monday for whether or not that pulls back or not. So yeah, I mean, when looking at stuff like this, you can't say set in stone that it's going to happen. But it's definitely a good indicator, and the more you like practice and the more you see, the more you'll understand that, you know, it does actually happen most of the time, which is cool. So it helps you.
So I guess the next question are basic options trading strategies.
So there's like several option trading strategies, but the two like super easy ones, and the ones that I mostly do, are credit spreads and vertical spreads. So credit spreads are like buying options or buying calls and buying puts of different strike prices. So if you go into a position with a credit spread and the stock price is at, let's say, $30, or the stock price is at $30. Let's say you buy a strike price of $31 for calls and a put price of $29 for puts. So that probably doesn't make much sense, but basically you buy in, it's sort of like hedging. So you buy in with the expectation that it could either go up or go down, so it kind of minimizes any loss whatsoever. So let's say it tanks, right? your puts are making money and your calls are losing money. But your puts have made just as much money as your calls have lost. But you know that it's going to continue to tank. So what you do is you sell your calls, and your puts will continue to make money and make money and make money. And you got in, and you had no idea what it was going to do. So and you lost no money, you've made no money until you sold your calls. But now that you know, then see that it's trading in a downtrend pattern, you can sell your calls and make money on puts. Vertical spreads are good for growing your account extremely fast, but they're also high risk, and you have to be not lucky, but you have to make judgment calls that you don't have 100% indication for. Vertical spreads is just buying all calls, or it's just buying all puts. So that's kind of how that works. So I would say those are the two main ones. Obviously there's more, and you could go more in depth, but for the sake of this video, it's just going to be, we'll just talk about the two.
All right.
So
next question is, I know that you obviously, like, you don't want to, like, wait till the option goes to, like, a penny and then, like, try to sell it there, but, like, what's a good percentage to call quits on an option when you've lost like so much of it percentage wise, or the stock has dropped a certain amount or something like that? What's a good point to drop at?
So when looking at stop loss, it would be options, as you'll see, are extremely volatile. And what I mean by that is you may be down 10% one moment, and then the next moment you're up 25%.
Yeah.
So the way to accurately judge an option price, or to judge a stop loss for an option price, would be to look at the underlying stock price rather than what the option price is. So that was a lot of like words, but to like simplify it, basically you look at the price of the stock, and if it drops 5%, not whether the value of your option drops 5%. And I'm just throwing 5% out there as a very conservative stop loss. I mean, some people may stop loss at 10%, 15%, 20%. I, on average rule, typically don't trade with stop loss, just because I'm constantly watching nonstop. But for those who are conservative, 5% or 10%, if you make a stop loss for that at the stock price, then you're almost guaranteed to, be safe no matter what. But you also risk the chance that if the stock price falls 5 to 10%, then it'll automatically cut your losses, and let's say it comes right back after that. You just wasted a day trade if your account's under 25,000.
Yeah.
And I mean, from someone who has to deal with the PDT rule, which is the personal day trading rule, it would just suck. I mean, it would waste a day trade, and it wouldn't be smart. It wouldn't be a good trading strategy, especially with small amounts of money, when you're trying to make lots of money at a time. So yeah, I think that pretty much covered that too.
All right. I guess the last question would be, what are good stocks to trade options on? Because not every stock is bought for options and doesn't have the greatest volume.
So there are obviously lots of like things that are good for trading options, but each thing comes with its own pro and con, and without going too much depth into that, there's volume that you have to look out for, because if you get into a contract with options and there's no volume in it, then you could be stuck with it if it doesn't go your way, which has happened to me before, and I'm sure it's happened to several people before.
Yeah, happened to me.
So the key for beginners especially, there's probably more experienced who can trade with lesser volume stocks and make a lot of money with them. But the key to beginners is to trade with options that have high amount of volume, that are weekly, because if you have weekly options, then chances are you can make a significant amount of more money in a shorter time. And yeah, some examples of high volume options would be SPY. So SPY would be a good example of that. That's where I've made a majority of my money with options, and while that's where I've made a majority of my money, that doesn't mean you can't make a majority of your money on something else. It's just what I've been able to see is predictable to a certain extent, or I've seen patterns that I've liked or trends that I've liked and I've been able to trade them. AMD is another example. NVDA is the one that I showed you the other day, where I had the 30% return in 15 minutes. QQQ is another good example, in MU. So if you go to Thinkorswim or Robinhood or whatever it may be, when you go to that particular website, it'll show you the volume for the particular option that you're trying to do. So there's an option, there's a specific button that you can see your particular the volume for any given option. Typically ones that have a volume of higher than like 300 or 400 or 500, those are the ones that people are actively trading that day, which is good, because if there's like zero volume, you know that you're making a bad decision because no one else is doing that decision either. And that's not to say that do what everyone else is doing, because that could get you in trouble. But if no one else is doing that option, then no one's going to be there to buy it for you. So, or yeah, to buy it from you when you try to sell it.
Yeah. So
you can buy it, but even if you buy it and try to sell it, if no one is buying it, then it's not going to work. So yeah, AMD, MU, SPY, QQQ, NVDA, all of those are good ticker symbols, I guess, that you could look at. That would be good to begin with. And the videos that you've already seen me trade with, those include NVDA and MU and SPY. You'll see why, because the volume is so high and they're weeklies. So what I mean by weekly is 3 of them, you'll have 3 a week. Typically expiration prices are on lesser known companies or lesser popular for option companies are once a week or twice a month or whatever it may be. But weeklies typically have expiration date contracts of 3 a week. And basically what that means is quick money. That's why they're so popular and that's why they're so high volume. So that's probably going to be it for tonight. Hopefully we can keep doing these so that, you know, beginners can ask questions and like figure it out. And if you have questions, then literally just write it below and then we can come back and talk about it some more. But do you have anything else?
Don't think so. That's it.
All right, well, cool. Thank you guys for watching, and we'll see you on the next one.